Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial market and a great educator as well. Thanks to all of you for joining me out there in the chat. And for those of you that are joining us on the recorded version, thank you for being here as well. Make sure that you pay attention and participate in that discussion. If you're on the recorded version, participate in the discussion by leaving comments in the comment section as well. Hey, we've got some interesting inputs into the market here this morning. A relatively hot CPI print that was kind of different than we've seen before. And so that may change the expectation. We've got the Fed speak timing going on, and we've got perhaps a little bit of change in volatility. So we'll see what is happening here with the indexes. We'll take a look at our 14-7 strategy as well. And maybe we'll look at mitigating out some of the impacts of time. So we'll talk about that in this discussion. As we jump in here, remember a couple of things. First of all, remember that everything we talk about simply for illustrative and educational purposes only. Shouldn't be considered any kind of an individualized recommendation or advice or endorsement of any particular security pattern or strategy. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options prior to trading any option strategy. Remember, the multiple leg option strategies will involve multiple commissions and transaction costs. Remember that spread trading must be done in a margin account. Also, remember, writing uncovered options, naked options, involves potentially unlimited risk. Now, we're going to talk about two different types of options. Primarily, we're going to be focusing on European style options, which cannot be exercised prior to expiration. That removes early assignment risk. But there are indexes that trade American style options. American style short options can be exercised at any time, which means that if you are short an American style option, there's the potential that you could be assigned at any time up to expiration. Whether it's in the money, at the money, out of the money, make sure you're aware of that fact. Remember, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform. The paper money version, great way to learn, not a guarantee future success out there in the real world, and it does not facilitate the early assignment of short American style options. So be aware of that as you move your practice from paper trading to live trading. Remember, of course, also that investing involves risk, including the loss of principal. Any type of financial analysis of the market is theoretical in nature. None of them guarantee any future success. Past performance of any security or strategy doesn't guarantee future results or success. Now we're going to talk about stops today in the context of a couple of our different strategies. Remember that stop orders are not guaranteed an execution price. We can specify the activation price, but not the execution price. And in the event of a stop limit order, there's a potential that that stop order, that price could gap around our limit area and the order not fill at all. So make sure that you are aware of some of those limitations and characteristics. And we'll talk about those as we go through the discussion. We're going to talk about index options broadly. We're going to use them as a way to assess what's going on with the market. We're going to talk about some strategies specifically, including our 14-7 strategy on the SPX that we've been talking about for the last few weeks. And we're going to look at some specific examples here on the Thinkorswim platform. So as we do this, I'm going to jump out to the Thinkorswim desktop paper money platform. We're going to take a look, start here on our index grid, which is the SPX, the NDX, and the what else do we have in here? The RUT, yes, that's it, the Russell 2000. Thank you. And we're going to see how the market seems to be reacting here this morning with that. I've got a bunch of questions in the chat, some requests, so we're going to jump into that. But I have a request of you. And it's very simple. You see that subscribe button down at the bottom right-hand corner. If you have not hit that button before, please hit that button now. Subscribe to the Trader Talks webcast channel. Make sure that you're aware of what's going on out there. You stay connected, and it's at no cost to you. So I lied. I have one more request. Follow me, follow Cameron, follow the other coaches on X, formerly known as Twitter. I'm at Ben Watson CS. Cameron is at Cameron May CS. He's got that pinned to the top of the page as well, so you can remind yourself of that. But let's take a look at what's going on. So we had a relatively hot CPI, namely, and CPI, again, remember, is Consumer Price Index. If we go to the Market Watch tab and we go to our calendar and we go to Econoday events, we can see what those Econoday events are. So I was going to take all of those off. We'll just leave our Econoday events on. Here is our information. So here's our CPI, which actually came out today. And it came in at a number, PPI, excuse me. So it came in at a number that was hotter than expected, number one. Number two, the primary inflation came in the sense of transportation, which is kind of part of this. If you were to think about this in terms of kind of the core or headline numbers, transportation costs are one of those, not transportation energy costs, not fuel and food, which are kind of the variables, but in the core, transportation costs, and it was primarily motor vehicle insurance. Yeah, it was CPI. Thank you, Carol. I appreciate that. But that's a big increase, and you can imagine, with the things that have been happening over the course of this last couple of months. We've had wildfires, we've had other disasters that have driven P&C, property and casualty insurance prices higher. That some of those insurance companies may need to raise rates elsewhere to accommodate that, and so we see some of those factors increasing. Also, eggs going up 15%, which is the highest increase from the egg index. We don't have an egg index, but egg prices certainly increasing as well. So there's still some inflation, and so what that does is perhaps push back the expectation of rate cuts on the part of the Federal Reserve. So timing comes in the context of Fed Chairman Powell speaking over the last couple of days, yesterday and today. He's going to speak again today, and so that may have an impact on the market. At the moment, the market saw a little bit of a gap down and a bit of a bounce. And I'll just zoom in on this index view. So we're looking at the SPX. This is the S&P 500 index. Remember, indexes are not tradable. Indexes are simply the aggregation of prices, whether they're cap weighted or equal weighted, of whatever the components are of the index, right? So hitting that 50-period simple moving average and kind of bouncing up, and we've been seeing this. If you notice what's been going on over the course of the last month or so, right? Rally up, a little bit of a pullback, rally up to roughly an equal or maybe lower high, a little bit of a pullback, rally up to a roughly equal or slightly lower high, and a little bit of a pullback, so maybe a little bit of a consolidation or a squeeze. Renting chickens. Now, Kevin, that's something I did not think about. I mean, we've thought about getting chickens. Didn't know we could rent them. That would be interesting. And I know you can rent goats, so why not rent chickens? But the market generally, the SPX generally kind of moving sideways here. Now, the one thing I did note this morning is that the RSI, that relative strength index, kind of as a momentum gauge, has kind of dropped a little bit below this diagonal trend line where it was climbing. So we were seeing, that's generally an indication of some accumulation against equal highs, that you see a little bit of that bullish divergence. But at the moment, we're kind of seeing that falling off a little bit, right back down to that 50-period simple moving average. Nevertheless, we're still seeing a little bit of a bounce here up off of the bottom. Not a big bounce, but it is a little bit of a lift. Buyers are stepping in and buying. And this is an area where there might be a little bit more a little bit more selective in terms of what they're buying rather than broad buying in this particular case. Let's take a look at the NASDAQ, which tends to be a little bit more technology heavy. I talked a little bit about this yesterday in my futures trading class, the comparison between the SPX and the NASDAQ and the fact that they are looking very similar might suggest that some of that technology leadership from the Mag 7, those big technology stocks that have been leading the S&P 500 and leading the NDX, maybe has been rotating out a little bit, considering the fact that the NDX and the SPX are looking fairly similar to one another. So we see the NDX coming back down into this push towards the 50-period moving average and doing just about the same thing. What hasn't changed here is really the drop in the RSI below that diagonal trend line. So maybe still a little bit of accumulation going on here, a little bit more strength in the NDX perhaps, and we get a little bit more of a gap down and rally today than we're seeing in the SPX, which would suggest that if there's some rotation back into equities, because we've seen a couple of days where there's maybe been a little bit of selling. We've seen overall, if we were to look at this from that standpoint, there's just been a little bit of selling and some consolidation. Then again, this might be an indication of some rotation back into some of those technology names. Not necessarily, but that is from a technical analysis perspective. And I don't know for sure. But from a technical analysis perspective, that might be, in fact, the case. Now, we'll pop back over here and take a look at the Russell 2000. And this is small caps. Small caps, if you remember, we've had this conversation before, small caps tend to be two things. One, they tend to be more sensitive to policy changes from an administration standpoint and geopolitical risks, number one. And number two, they tend to be more sensitive to interest rates because of borrowing costs and things like that. And with interest rates rising, that's not necessarily a good thing for the Russell 2000. In fact, we're seeing the Russell breaking a support level here, maybe coming right back down to another support level here, breaking at the bottom of that diagonal uptrend line on the RSI. So a little bit stronger down day on the Russell 2000, which would make sense considering that it is sensitive to rising rates. So what I want to do really quickly while we've got this on here, I want to kind of address a question that somebody asked me in the chat earlier in terms of things like bonds, right? So what I'm going to do is I'm going to go to my studies or my little flask icon up here, and I'm going to put on a study called a comparison study, COMMP. So you just type in the start of the word and it'll pull up by match here, the comparison study. So I'm just going to double click. And I'm going to do a comparison study now. By default, it brings up the SPX index. Well, okay, I can see that side by side here. But what I'm going to do is I'm going to go to the gear icon. I'm going to come back over here. And the symbol that I'm going to put in here is /10Y. And this is the 10-year Treasury yield futures symbol. So we're using this not to trade the futures, but we are using this as a means to display what's going on in yields. So we're using this as a market indicator, not a trading instrument. So /10Y, we're going to go ahead and click on OK and apply an OK. So here is yield movement. And we can see if we zoom in here on the right-hand side, yields were going down, Russell was rising. Yields moving up, Russell is moving down because of that interest rate sensitivity. And so from that standpoint, there's two things going on. One, companies that are more interest rate sensitive are maybe selling off a little bit more because of this possibility of higher for longer rates. Number two, Russell 2000 stocks in this index, they rebalance every June. And the most recent rebalance, we had this conversation, I think, a couple of weeks ago. The most recent rebalance in this index was into a higher concentration into technology stocks, small cap technology stocks. Well, if there's a rotation back into tech leadership, to Carol's plea here, please, a rotation back into tech stocks. If there's a rotation back into tech leadership, away from some of the small cap tech stocks that are maybe more interest rate sensitive, then that could also exacerbate this downward movement in the Russell broadly, as those investors who were looking for new opportunities within technology were seeking out some of those lesser known names, but maybe they're coming back into some of those big leaders. So what I want to do before we even go a little bit further than this, and we've got more to cover today. Boy, I'll tell you what a busy day to be talking about this, but I think it's really fascinating. Let's go to the Market Watch tab and let's go to our Visualize tab. And I want to go down here now to the NASDAQ 100. And again, we'll compare the NASDAQ and the Russell here in this case. So this is technology, and these are large cap technology stocks, right? So let's take a look at where the leadership is. It's not right now in NVIDIA. They're down a little bit. They're down about a little over 1%. It's not Microsoft, which has been one of the leaders as well. It's not Amazon. It's not Google. Meta is neutral at this point. But look at where some of that leadership is coming back in here. Palantir has been on fire for a little while. And just got stopped out of a position. All right, there's Apple seeing some leadership. Intel, for crying out loud, seeing some leadership. NXPI, Palantir, as we saw, and Tesla booking Airbnb. So maybe a little bit of rotation. We'll see if this bears itself out. Now let's go to the Russell 2000, and let's go to that information technology space within the Russell 2000. So we'll come back down here. We'll go to information technology just in the Russell 2000, and we'll see where some of that SMCI seeing that leadership. But you're seeing some pullback elsewhere, right? So RMBS is coming down onto innovation. You're seeing some strong red movement, downward movement in some of these, again, smaller caps. So you notice where the gains are coming. They're in some of these Rigetti, the AI ones, but they're in some of the larger capitalization moves in the Russell 2000, where you're seeing a little bit of strength, but everything else, for the most part, seeing some kind of a sea of red with a few green islands here. I thank you for bringing up the real estate perspective, because it would certainly seem kind of getting whacked across the board here in the small caps. So that's helping to bring the small caps down as well. If we were to come back over to the S&P 500 and put it in the real estate sector, you can see the same thing happening here in the real estate sector. But if we go to information technology, there's the flow. It's into the Apples, the Palantirs, the Intels, and so forth. And so breaking down the indexes into their components, we can see kind of some of that movement going on. So how does that help us? Well, it helps us in two ways. One, it gives us potentially the opportunity to see perhaps some speculative movement in the Russell 2000, but it also gives us the opportunity to maybe see a little bit of a continuation of sideways movement in the SPX and the NASDAQ. So we're going to take advantage of that kind of sideways to neutral movement in a couple of different strategies. But before we do that, I wanted to show you some additional resources to kind of see this rotation. So somebody asked the question earlier, well, wait a second, why are these indexes staying strong when we had that hot CPI print and bond yields are going up? Well, think about what drives bond yields up. Bond yields go up when bond prices go down. And if bond prices go down, that means that bond holders are selling their bonds, theoretically. And if bond holders are selling their bonds, well, that means they got to put their money somewhere else to gain return. So they might move that into equities, and then looking for some of that technology leadership. So where do you go to find information about that? Well, you can come right here to schwab.com, and you can come down here and you can learn more about some of those characteristics and some of those ideas. Things like stocks and trading. There's going to be some resources here and some playlists that will focus on things like bonds. You can come right here and type in BONDS, bonds, and you can learn more about bonds. You've got Brent Morris talking about navigating bonds, an essential introduction to bonds. That might be a great place to start for those of you that were asking me the question about bonds. How do I learn more about bonds? There you go right there. And again, another webcast that Michael Fairborn teaches, generating income in your portfolio, bond basics. So lots of resources that you can use to learn more about that interrelationship. But it's always a good idea to kind of broaden your horizons and understanding of what's going on in the market. All right, now that we've got that, I want to look at one other thing before we jump into this, because it's always a good idea to pay attention to what volatility is doing. So I'm going to bring up our VIX grid, and we're going to see what volatility is doing. Now, this chart, I will tell you this. Notice what's on this chart. What's happened is some of these spikes that we had that were kind of normalizing this chart, because this is a one-year daily chart, have dropped off the left-hand side. All we're left with in terms of big spikes is this big one that we saw on the yen carry trade unwind, right? And so what that's doing is it's compressing everything else on the chart. So what I want to do is I just want to zoom in on this time frame right here. And now you see a little bit more variation. Now, volatility generally is still very low when it comes to the market. But if you notice what's going on here, and again, remember, volatility isn't necessarily, or the VIX doesn't necessarily operate in terms of the levels of support and resistance that we would look at on a tradable instrument. But notice what's happening there. Volatility generally starting to pick back up a little bit. We're starting to see that baseline of volatility increasing, the average of volatility increasing. Volatility today, even though we saw an initial downward move in the market, the VIX is still moving a little bit up, but it's not spiking. There's not abject fear, at least in the market. But what that suggests is that volatility for indexes, specifically the SPX, is perhaps increasing just a little bit, up 2.68% on the day so far. So not huge, not a huge spike in volatility, not like what we've seen before. So you got to put it into context, right? So this maybe gives us a little bit of sense of that. So implied volatility is staying a little bit higher. However, that's not the biggest driver necessarily. I mean, we see, directional price movement being the biggest driver generally of this market, news being a big driver. This is a coincident or after the fact. This is kind of the close the barn door after the horse has gone out type of indicator for the most part. We don't typically tend to see, unless you start to see that little bit of a pickup ahead of, because institutional participants typically tend to be reactionary as opposed to proactive generally. So we typically won't see this pickup until the news has happened, right? So, all right, now let's do this. Let's go over to our monitor tab, and there's a couple of things that I wanted to talk about now that we're here. And we've got a couple of positions that I want to look at. We've got two groups that I've been using for this class. We've got our index options group, and then I've got our index options weekly, which contains our 14-7 strategy. The first one I wanted to deal with was this one right here, which is XSP. Now, XSP is the mini SPX. So if SPX is the index, XSP is the mini version. That's 1/10 of that, right? And we were long a put option, meaning long the put, looking for protection, kind of offset to our overall portfolio to reduce some deltas, or looking for speculation if it went to the downside. Now, we put that trade on, that long put trade on. We put that trade on back on December 27th. We went long this put option. It is now down to 9 days to go until expiration. So two things are happening here. One, we've lost most of the extrinsic value in that option. It's now, so the index is currently trading at 602. This is an out of the money option. So out of the money slightly by about a point, half a point in this particular case. So all that's remaining here is any extrinsic value. We don't have any intrinsic value in this at the moment. Now, what that means is, as we get closer and closer to expiration, meaning as these 9 days fall away, this is going to decay away, and it's going to decay away faster and faster and faster because it's fairly close to the at-the-money position. And our time decay, that theta sensitivity in our option Greeks, is higher at the money, and it gets higher and faster as we get closer to expiration. If you want to learn a little bit more about the option Greeks, I'm going to ask Cameron to jump out and grab, I think he taught a webcast on the option Greeks, on understanding option Greeks. That's really good. I know Brent Moores has done that. I've done that as well. But grab one of those webcasts that talks about option Greeks if you've got questions about Greeks and Greek sensitivity. We'll use that as a context in this discussion. But it may be time to kind of peel this back and either roll it out or simply close it at this particular point and then look at putting another one on further on. Which, same thing as a roll, right? We're just not going to do it in one transaction. So what we might do is just simply say, okay, I want to put some protection on, perhaps, because protection still is relatively inexpensive, right? So that's a great question, high-speed low drag, because in this particular case, we've lost, you're absolutely right, we've lost just about, well, a little bit more than 50%. We've lost 62% of the premium that we paid for this option to begin with. But here's the thing, right? Here's the thing. This was a protective put. This was a put designed to either offset downside movement or give us a means to exit a larger position. And so we were using this as a hedge, not as a speculative position. But you're right, it's lost 50% of, or more than 50%. So perhaps time in this particular case to take this off and look at putting another one on. But you think about protective positions, and generally we don't think about buying protective positions for the sake of making money on the protective position, because it often means we're taking a larger loss. So elsewhere. So we're going to simply look at this as a sunk cost. We sunk 50% or about 60% of this into that protection. And so now the time may come to close this down. And so a trader may come up here and create a closing order, and we'll look at closing this down. There's our order in this particular case. We're going to click on confirm and send. We're going to say, look, we're going to close this trade down, make sure that this is a closing order. We're going to eliminate this long put option, make sure that we're aware of any alerts that might come up, and we're going to go ahead and we're going to click on send, and we're going to fire that order off. So we got it for $4.30. We salvaged $4.30 of the $11 we paid for to begin with. So we took a little bit of a loss, but it was there in the event that the price of that index went down, the SPX, and kind of offsets or buffered some of that downward movement. So we'll look at putting another one on here first in just a second. But I want to come back over here to our index options weekly strategy. And a number of you have asked the question, well, wait a second. Why did we choose 14 and 7? Why do we sell the vertical spread where we sell it? So let's kind of explain the strategy. The strategy here in this particular case is going out 14 days to go until expiration and selling an out of the money put vertical. Because our trend, if we go back to our chart, we go back to our index grid, our trend is still bullish. Now the candles kind of turn red here. But you notice the 50 period, the 200 period moving averages are still moving higher. They're still trending up, and we haven't made a new lower low yet. So we're still in kind of bullish mode here. But I did have a request to maybe look at this from that bearish perspective. So we'll look at that too. So we're going to go back over here to the monitor tab, and we're going to say, look, now is our time to buy this back. So we sold it for $1.10 to begin with. We're going to buy it back for right around 45 cents if we can. And then we're going to look at selling another one 14 days out. So we're going to create this closing order first. So I'm going to do this, create closing order. Now, we could do this as a roll, but I want to do this step by step so that you understand the steps. If we were to do this as a roll, remember, rolling's not a magic wand. It doesn't eliminate transaction costs. It doesn't make it cheaper. It just simply makes it more convenient, and it requires that there's a liquid option market in our target order, or target expiration, target strikes. So we're going to go ahead and we're going to close this down, and we're going to try to get this, if we can, we're going to try to buy this back for 45 cents or better. Maybe we might have to work it a little bit. But let's see if we can get it for 45 cents or better. We're going to go ahead and click on confirm and send. We're going to try to close this down, and we'll fire that order off. And we got it for 40 cents. Cool. Buying it back for 40 cents as opposed to buying it back for 50 cents is even better, which means that we got to keep out of our $1.10. What did we get to keep? We got to keep about 70 cents of premium. Now, it doesn't seem like a lot, but 70 cents. I go back to the old, if you remember the old the sketch character on Saturday Night Live, Father Guido Sarducci, and he was talking about the cost of sin. He says, those sins pile up, even if they're 25 cents, 25 cents and 25 cents and 25 cents and 25 cents. And pretty soon you got a lot of sin. So if we do this strategy again and again and again, and we pile up 70 cents and a 70 cents and a 70 cents and a 70 cents, that strategy, as long as that continues to move, and you're right, absolutely, George, as long as the strategy continues to work until it doesn't, then that strategy, again, I'm not recommending this strategy. We're simply using this as an illustrative example. So now we can go out to our 14-day expiration, which is going to be the 26 Feb expiration. That's going to be looking out over the horizon 2 weeks. And we're going to go to our chart. We're going to determine where we're going to sell this spread. So now we're going to bring up our grid that we've been using for this, which is our index. Where is it? Index options grid. There it is, our index options grid. And if you remember, what we have on here on the left-hand side is a 1-year daily chart with the MACD. So we see momentum. And then on the right-hand side, we have a 3-month daily chart, and we've got the probability of expiring cone at 1 standard deviation. Okay, this is 1 standard deviation. So we know that our expiration that we're targeting in this particular case is the 26th of February. That's 14 days out. So what I'm going to do is I'm going to move my horizontal or my vertical line here on my cursor out to that date, which is the 26th of Feb. And what I'm going to do is I'm going to come down, because what's going to happen with that probability of expiring cone is that it's going to expand or contract based on implied volatility. If implied volatility rises, that cone gets wider. If implied volatility contracts, that cone gets narrower. And so I'm going to come back down here to that 226 crossover between the probability of expiring cone and time. So 14 days out, probability of expiring cone, and we're right about the 5842 level here. And I'm just going to put a line here so that we can see where that is. Okay. So what that's saying is within 1 standard deviation, that's where the bottom range of this market movement is likely to be in the next 14 days. And if you notice, if we go back over to the left, again, always a good idea to look left to confirm right. Where is that kind of general area of support where the market has been over the last couple of months? It's right here at about that 5840 area, right? I will share this grid again. It's also in the description of this webcast, but I'll go ahead and I'll share it right now. And remember, anything that we share simply for illustrative and educational purposes only, and it is not guaranteed as to time or accuracy, right? Okay. Yeah, Alan, that's there's similar correlation. You could do it assuming that there's liquidity, right? So here's what we're going to be targeting. We're going to be targeting 14 days out, right around that 5842 strike. So let's go to the trade tab. We're already in 14 days out. 58, where was our 5842? Is our crossover. So we're going to go to the trade tab. We're going to have to add some strikes here. So let's add about 100 strikes. 5840. So we don't have a 5842. So I'm going to round up. I'm going to go to the 5850. That's about the 15-cent delta. So the other thumbnail here kind of consideration might be right around the 15 delta. That's where it's worked the last couple of times that we've done this. And so what we're going to do is we're going to sell a 1 strike wide, $10 wide vertical spread here. And let's see what we can get out of it. 15 delta. We're going to sell the 5850. And we're going to buy the 5840. Now, we're creating a vertical spread. Now, notice something that's happened here. Our credit has decreased a little bit, right? So did we sell a one strike wide or a two strike wide? 58.35, 58.25. No, it was $10 wide the last time. So we're still $10 wide here in this particular case. 58.50, 58.40 is the credit spread that we are looking at selling here. So we're bringing in a little bit less premium. What that tells me is that volatility maybe has increased, but at the same time, not necessarily impacting these. It's given us a wider probability curve. So sometimes we get more, sometimes we get a little bit less in this particular strategy. So we're going to try to get, if we can, at least a buck out of this, maybe $1.05. And we're going to click on confirm and send. We're going to put this vertical spread in our index options. Now, remember, we got to pay attention to what the max loss is here. Now, our max loss in this case is defined. Max gain potentially $1.05, max loss $8.95. But what would have to happen in order for us to get to that? The price of the index, the SPX, would have to be below 58.40 at expiration. We're not going to let this go till expiration. The intent is we let time decay do its thing, number one, and we let direction do its thing, number two. So we're going to sell this vertical spread. We're going to click on confirm and send. We're going to read through this, make sure that we're aware of that, and we're going to try to get that $1.05. We'll see if we can get it. We'll see if that'll give us that $1.05. We might have to work that, and we got it for $1.10, even better. Selling it for more is better. That's what a limit order does, is it gives us that potential. It says that's our baseline. That's what we want to get. So we're going to sell it. We sold it for $1.10. We go back to our monitor tab, and now here's our 14 days. And so what we're going to look at targeting is closing this trade out 7 days to go until expiration, right? So that's going to be the 19th of February. That's going to be next week, right? That's going to be next. Let's see. Yeah. Yeah, 19th of Feb is going to be next week. Yep, next Wednesday. Okay, so High Speed Low Drag says, why not do an iron condor? Yeah, we could, absolutely. It is moving sideways, but we are in an uptrend, right, generally. So we're using this as a means to take an uptrend in this particular case. You could certainly do an iron condor here as well, right? So again, this is a matter of consistency, right, in this particular strategy. There's lots of different ways that we could tweak this. We could put on here a sell order that would get us out at 50 cents or whatever, and we might consider doing that. Yeah, so we're not leaving it open-ended necessarily, Jerry, in this particular case. If you want to put, if a trader wanted to put an exit order on this spread to take the trade off, if it's made 80% of that theoretical maximum gain, in this particular case, the math is pretty simple, right? In this case, if you were to right-click, create a closing order, put that closing order on and make it a limit order to say, look, I want to get out of this trade if this trade is trading at 30 cents or less, if that vertical spread is trading at 30% or less, and then you made that a good till canceled, then that order would sit there and take the trade off if you got some intraday volatility, and maybe take that trade off after it's done the majority of the work. So you could do that. You could certainly further the automation in that particular trade as well. Okay. So there's that strategy. Now, the other thing that I wanted to do here was in that circumstance of the market kind of moving in that sideways direction. So let's go back to our charts here, and let's look at that scenario here. Let's go to I want to go to our index grid one more time, our YFT index grid, and we're going to pop over to the Russell 2000, which we saw moving down, right? You see that moving down. I suspect this, again, from a technical analysis perspective, might find some support down around this range, down around that 22.25 mark or 22.30 area, where it might find some support. It's been moving down. Volatility has generally been moving up a little bit. So what I want to do is I want to come back over here to my index grid that we've been using, that index options grid, and we'll put in here, let's put in here our RUT. Let's use the Russell in terms of liquidity. So I want to be looking right around this 2230 level, right, as that support level. So I'm even going to maybe just draw that line in a little bit here, right around that 2230. Okay. So what I want to do is maybe take advantage of that possibility of a slight decline and relatively low volatility in this particular case. And I want to look at trading this kind of in a fairly narrow range. So what we're going to do in this particular case is we're going to go to the trade tab for the Russell 2000. And I'm going to go out here. We're going to create a calendar spread pretty quickly here. So what I want to do in this calendar spread, and we're going to do this fairly quickly because I know that this is a strategy we talk about in a variety of other scenarios, but I'm going to pick some Friday expirations here. So we're going to go to the 21 Feb expiration, 9 days to go. And we're going to go out to the, let's go out a little bit longer than that. Let's go out to the 14 March. Let's go to the 14 March expiration. So 30 and 9. We're going to go to the short leg, or the short leg 9 days out and the long leg out 30 days. So what we're going to do is we're going to go to the 9 days till expiration first, 21 Feb expiration. And we're going to go to that 2230 strike. So let's find our 2230 strike. There it is. We can sell that 2230 strike for about 18 bucks. That's about the 38-cent delta. So it's inside kind of that one standard deviation range. And I'm going to sell the 2230 strike because that's where I expect price to kind of move towards. And at the same strike price, that further dated expiration, I'm going to go to the 2230 strike, and I'm going to buy this one. I'm going to buy the 14 or the 30-day expiration 2230 strike. Now what I've created is a calendar spread. Now, this is a bit big just in terms of debit getting into the trade because this is the bigger index. We could use the minis or the micros if we wanted to as well. But what I wanted to do is just illustrate this, and I'm going to send this to the Analyze tab. And so what I'm seeing here on this Analyze tab, and I'll just kind of spread this around a little bit, is let's make our probability range match our expiration, which was the 14th of March. So we'll go out to the 15th of March. And you can see this shaded area is kind of the probable range based on implied volatility of where this index is likely to be out to that expiration, the 15th of March. And the point of our calendar spread is kind of right almost on that kind of midpoint, if you will, of that probabilistic range. So what I want to do is I want to think about taking this trade off, though, not when we're not going to try to hit this target right here. We're going to try to hit a target that's kind of right in this area instead. So our goal in this type of strategy, and you notice that this has a pretty small range of potential maximum gain. It's from there to there. Pretty large range of maximum loss, right? All the way down to there. So this is an area of some loss. Down here is maximum loss. This is an area of some gain. Here's our area of max gain. So we're kind of playing the probabilities here, playing this broader area in terms of a calendar spread. So what I want to do is I want to clear our annotations here, and I want to bring this back to my pointer, and I want to say, look, I'm going to put my pointer. Why am I getting that? Okay. So we're going to put our crosshairs kind of right about here. We're going to say, what's our potential gain? Okay. So about there and about there. What's our potential gain if this kind of moves up or down, right? And kind of stays as we close this trade out, kind of right in that area of about If we're taking this all the way out, because our probability, hang on a second, let's reset our slices here. Let's look for our probability of expiring. And right about there, 2230. So we've got a break-even range kind of right in that area. And so we're going to be looking at taking this trade-off for about a 50% gain. Okay. So let's just kind of run the numbers here really quickly. 2145. 2145 plus 50%. It's $10 gain. So we're going to look at taking this trade off if it trades for 32 bucks. Okay. So we're going to come back to our order entry tool really quick. And we're going to make this a first triggers sequential. We'll right click and create an opposite order. And we're going to buy this back or sell this back, excuse me, if we can sell it back for, what did we say, 32? $32 will make that good till canceled. So the calendar spread, our expectation is the price is going to stay near our expected price or near the point of that calendar, but we're not going to try to get maximum theoretical gain, which would be double this basically. So we're going to take about 50% of that maximum gain, add that to what we're paying for it, and that's what we're going to try to get out of this trade for, about that $32. So we're going to click on confirm and send. We're going to put this in our index options group, and there's our calendar spread on the Russell 2000. So guys, as we do this, again, this is a strategy that can be kind of an interesting approach. One of the ways that we might take advantage of index option movement. But guys, thank you so much for paying attention and asking questions here in this discussion. Thank you for being here and following us on X and following Trader Talks webcasts. We'll see you guys again here next week, and we will jump back into this discussion. Thanks, everybody. Take care. Bye-bye.